So you've been lucky enough to sell your home this year. Well, join a very small group of Americans who are able to say that. Now you're worried about income tax issues. Hi, Bob Jennings here to try to answer those questions for you. IRS and Congress many years ago established in 1997 a completely new set of home sale rules, and they basically say that you don't have to pay tax on any profit that you make on your home if you meet 4 simple rules. Now, before we go further, what if I sold my home at a loss? Bad news, no deduction. Only special rules on the sale of a home apply to sale of a home at a profit. If you sell it at a loss, there is no deduction. How do I avoid tax on the profit? Here are the 4 rules. First, the home you sell has to be your primary residence. If you're selling a vacation property in Florida or Arizona, these rules don't apply. You have to pay tax on that profit. So number 1, it has to be your primary residence. Number 2, you have to have owned the home for 2 out of the last 5 years. Easy enough. Number 3, you have to have lived in the home for 2 out of the last 5 years as your primary residence. And number 4, you cannot have taken a home sale exclusion in the last 2 years. If you meet those 4 rules, primary residence, live in it and own it 2 out of the last 5 years, and you have not excluded a gain in the last 2 years, then you're allowed to avoid tax on the first $250,000 of profit as a single person and $500,000 of profit in the case of most married people, no tax whatsoever on the profit that you earn on that home. What if you're an extremely lucky American and you actually make more profit than those dollar limits? Any amount over $250 or $500 on a married couple is taxed at capital gains rates. So let's summarize. You sell a home at a loss, you're done. No deduction, no nothing. You sell the home at a gain, you probably don't have to pay tax on it as long as it's your primary residence, you lived there 2 years, you owned it the last 2 years, you have not previously excluded the gain on a home sale in the last 2 years. You can exclude $250,000 single, $500,000 on most married returns. Here's the last point. If you have owned the home less than 2 years and you have to sell the home because of what we call unforeseen circumstances, a job change, medical change, or a whole lot of other situations, the IRS will allow you a reduced amount that you don't have to pay tax on. For example, let's say that you lived there 18 months out of the last 24. You take 18 divided by 24 times $250,000, and you still wouldn't have to pay tax on that amount. For further information, please visit us at our website at the bottom of the screen or at the phone number that you see. Thanks again, my friends, for listening. Bob Jennings signing off.